The NVC Fund Holding Trust has proposed a highly unusual monetary operation, depositing $1 billion in digital stablecoins to trigger the issuance of 1.6 trillion Nigerian fiat Naira. This operation is designed to address an immediate regulatory deadline. The Central Bank of Nigeria has recently enforced a strict new minimum paid-up capital floor for all commercial banks operating within its jurisdiction. To maintain a national commercial banking license, institutions must now prove they hold at least 200 billion Naira in paid-up capital. Several institutions fall short of this new metric, including Polaris Bank and Unity Bank plc, marking them as the primary targets for this recapitalization effort. Under the terms of the proposal, executing this transaction would grant NVC Fund a 100% full acquisition of Polaris Bank and a 90% controlling equity stake in Unity Bank. Generating 1.6 trillion Naira to fund these acquisitions immediately raises a severe macroeconomic red flag. Creating that volume of domestic currency out of thin air typically invites severe hyperinflation and currency depreciation. However, examining the mechanics of this specific proposal reveals it is neither deficit monetization nor unbacked money printing. The operation uses an existing legal mechanism to convert a digital crypto treasury into a recognized sovereign reserve asset. Because it relies entirely on foreign capital entering the central bank, it bypasses the need for the federal government to borrow any money. The legal authority for this expansion comes directly from Section 19 of the Central Bank of Nigeria Act of 2007. Section 19 gives the central bank statutory power to issue new currency notes and coins, on the strict condition that the new issuance is backed by eligible external reserves held in foreign currency. By structuring the stablecoin deposit as a sovereign foreign currency reserve certificate, the transaction legally functions as a bilateral currency swap agreement. While utilizing a digital stablecoin is a modern application, the bilateral swap mechanism itself is a standard tool used to manage international liquidity. The United States Federal Reserve regularly uses identical swap line structures to provide dollar liquidity to foreign central banks, empowering those banks to issue local currency against the newly acquired dollars. Both the European Central Bank and the Bank of England execute similar bilateral agreements to stabilize allied economies. The closest functional analogy is when a nation receives a special drawing rights allocation from the International Monetary Fund. The central bank records the SDR as a reserve asset, which in turn authorizes the issuance of equivalent local currency. The Sovereign Foreign Currency Reserve Certificate operates on this exact principle. By guaranteeing a one-to-one foreign asset backing before a single Naira is minted, the structure aims to neutralize the inflationary risks typically associated with large-scale domestic currency creation. This dynamic T-account diagram shows the central bank's balance sheet, split between external assets on the left and domestic liabilities on the right. To understand the economics here, we have to look at how the ledger expands. During the first 3 days of the operation, NVC Fund transfers $1 billion in the NVCT digital asset into the central bank's reserve custody account. This asset is AAA credit rated, supported by a $30 trillion treasury, and structured to maintain a strict one-to-one peg with the US dollar. Custody is established through a base mainnet smart contract transfer, immediately followed by ISO 2022 compliant wire confirmations to satisfy institutional compliance. Once verified, the central bank officially records the certificate as a published foreign reserve asset. For context, Nigeria's total external reserves as of early 2026 sit at approximately $38 billion. Adding this single deposit creates an immediate 2.6% increase to the nation's overall reserve adequacy ratio. By ensuring the asset side of the ledger expands first, the country actually strengthens its position against the IMF's 12-week import cover benchmark before any new local currency enters the economy. With the billion-dollar reserve secured, the statutory authority under Section 19 is triggered, and we move to the liability side of the ledger. The issuance volume is determined by the central bank's official exchange rate, set here at 1,600 Naira to $1. Applying that multiplier, the Currency Operations Department mints 1.6 trillion in equivalent Naira liabilities. The result is perfectly symmetrical. For every single new Naira added as a liability, there is a corresponding fraction of a verified digital dollar holding it up as an asset. This structure avoids the pitfalls of unsecured issuance, where a government expands domestic currency liabilities without adding new foreign reserves to back them up. Because the federal government does not issue bonds to fund this operation, no new sovereign debt is created. The new Naira is fully underwritten by external capital, neutralizing the downward depreciation pressure that usually follows large-scale currency printing. The final stage of the operation dictates exactly where this newly minted capital must irrevocably go. The first tranche of 800 billion Naira flows directly into the designated regulatory capital account of Polaris Bank. Inside that account, 400 billion is dedicated to Tier 1 common equity, while 300 billion is assigned to clear existing deficits and absorb prior losses. The final 100 billion of that tranche is held as operational working capital to ensure immediate liquidity. This injection pushes Polaris well past the 200 billion Naira regulatory minimum, finalizing NVC Fund's 100% acquisition of the institution. The second 800 billion Naira tranche is routed under the exact same supervision to Unity Bank. Here, 450 billion Naira eliminates the bank's deep shareholder deficit entirely, paving the way for a clean 250 billion Tier 1 capital injection. The remaining 100 billion acts as a growth fund, specifically targeted toward expanding digital and agricultural finance operations. Unity Bank clears its regulatory hurdles, and in exchange, NVC Fund secures a 90% controlling equity stake in the newly stabilized bank. Operating entirely through standard central bank supervision channels, the operation systematically rescues 2 major national banking licenses in under 14 days. This diagram shows the completed macro view, a central bank balance sheet anchored by verified foreign assets, actively supplying capital to a newly stabilized commercial banking loop. The certificate binding these assets operates on a 10-year tenor. At the end of that decade, NVC Fund has the option to redeem the initial deposit in US dollars at the prevailing exchange rate, or convert the certificate into additional bank equity. To protect the depositor during that holding period, the certificate is legally structured as a first priority claim on the central bank's reserve assets. The entire framework is pre-cleared by strict alignment with the Financial Action Task Force's anti-money laundering standards and Article 8 of the IMF's Articles of Agreement. The NVC Fund Recapitalization model provides a clear mechanical proof of concept. When bound by rigorous, legally compliant bilateral swap architecture, highly liquid digital treasuries can directly execute sovereign monetary policy, resolving systemic banking distress without adding a single dollar to the national debt.